7 secrets banks don't want you to know. Ever feel like banks are working against you instead of for you? What if I told you that banks have hidden secrets designed to make them richer, while keeping you trapped in fees, debt, and low returns? 7 secrets banks don't want you to know. Banks are an essential part of our financial system, offering everything from checking accounts to loans and investment opportunities. However, behind their polished advertisements and promises of financial security, banks operate in ways that often favor their own interests over those of their customers. Many hidden practices and industry secrets exist that banks would rather keep out of public view. In this deep dive, we expose 7 secrets banks don't want you to know, revealing how they make money, manipulate interest rates, and keep consumers in financial traps. In this video, I'm exposing the biggest banking secrets that could be costing you thousands, and showing you exactly how to beat the system. Stay till the end for money-saving hacks banks hope you never find out.
Let's get started.
1. Banks make money off your money, even while it sits in your account. When you deposit money into your bank account, you might assume it's just sitting there, waiting for you to use it. In reality, banks immediately put that money to work, using it to issue loans and investments that generate them substantial profits. Banks operate on a fractional reserve banking system, which means they only keep a small percentage of total deposits as cash reserves while lending out the rest. They earn interest on loans, while paying you almost nothing in return. For example, while a savings account might offer 0.01% interest, banks could lend your money out for a 6% mortgage or a 20% credit card rate. Even when you swipe your debit card, banks charge merchants transaction fees, earning more money simply because you keep funds in their system. What you can do: consider alternatives like high-yield savings accounts, credit unions, or even investing in money market funds to maximize your earnings. 2. The true cost of free checking accounts. Many banks advertise free checking accounts, but these accounts are rarely truly free. Instead, they often come with hidden fees and conditions that can quietly drain your balance. Overdraft fees. If you overdraw your account, banks may charge a $35 fee, even if you're just a few cents short. Some banks reorder transactions from highest to lowest instead of chronologically, increasing the chance of multiple overdraft fees. Minimum balance requirements. Some accounts require a minimum daily balance to avoid fees. If you fall below this, you could get hit with monthly maintenance charges. Excess transaction fees. Some accounts limit the number of free withdrawals or transfers per month, charging you if you exceed the cap. What you can do: read the fine print on checking accounts. Consider switching to online banks or credit unions, which often have lower fees and higher interest rates. 3. Your credit card interest rate can be raised anytime when you sign up for a credit card. You agree to an interest rate, often an introductory rate that seems attractive. However, banks reserve the right to increase your rate at almost any time. Variable interest rates. Many credit cards have interest rates tied to the prime rate, which means your April can rise without warning. Penalty APRs. If you're late on a payment, even once, your bank may hike your rate up to 29.99% or higher. Universal default clause. Some banks still have policies that increase your rate if you miss payments on other bills, even if your credit card payments are on time. What you can do: always read the fine print. If you carry a balance, look for low-interest credit cards or consider 0% balance transfer offers to minimize interest charges. 4. Banks manipulate interest rates for profit. Interest rates on savings accounts, mortgages, and loans aren't just set by the market. Banks often manipulate them to maximize profits. Savings account rates stay low. Even when the Federal Reserve raises interest rates, banks are slow to pass those increases on to customers. Mortgage and loan rates increase instantly. When interest rates rise, banks are quick to raise mortgage and loan rates, ensuring they profit from the change. LIBOR and other rate manipulation scandals. Banks have been caught manipulating key interest rates, like the LIBOR scandal, where major institutions rigged rates for their own benefit. What you can do: if you're borrowing money, compare lenders and negotiate your interest rate. If you're saving money, look for high-yield savings accounts, CDs, or alternative investments. 5. Banks sell your data to third parties. Banks collect massive amounts of data on your spending habits, income, and financial behaviors. What they don't tell you is that they often sell or share this data with third parties for profit. Banks track where, when, and how you spend your money. They share this data with advertisers, insurance companies, and financial service providers who then target you with personalized offers. Some banks even use AI and predictive analytics to determine which customers are likely to need loans or investment products, allowing them to market more aggressively. What you can do: read your bank's privacy policy and opt out of data sharing programs when possible. Consider using privacy-focused banks that prioritize consumer data protection. 6. Banks make it hard to close your account. If you've ever tried to close a bank account, you might have encountered a frustrating maze of obstacles designed to keep you from leaving. Hidden fees. Some banks charge early closure fees if you close your account too soon after opening it. Automatic transactions keep it open. If you have recurring payments or direct deposits, banks may deny your closure request until all transactions clear. Account reactivation tactics. Some banks reopen closed accounts if a deposit or charge comes through, leading to unexpected overdraft fees. What you can do: before closing an account, ensure all automatic payments are cancelled, withdraw your balance, and get written confirmation that your account is closed. 7. Banks don't always keep your money safe. While banks promote FDIC insurance as a safety net, there are limitations to how protected your money really is. FDIC insurance limitations. The FDIC only insures deposits up to $250,000 per account type per bank. If you have more than that, your excess funds aren't protected in case of a bank collapse. Bank failures are more common than you think. While rare, banks can fail, as seen in the 2008 financial crisis and more recent banking collapses. Risky bank practices. Some banks invest heavily in risky derivatives and securities, which means your deposits might be used in high-risk financial bets. What you can do: if you have large sums of money, spread deposits across multiple banks to stay within FDIC limits. Consider investing in diversified assets rather than relying solely on a bank. Final thoughts. Take control of your finances. Banks play a crucial role in our financial system, but they aren't always working in your best interest. Understanding these 7 banking secrets empowers you to make better financial decisions, avoid hidden fees, and maximize your money. Now that you know the truth about banks, don't let them take advantage of you. Which secret shocked you the most? Drop a comment below. I'd love to hear your thoughts. And if you found this video helpful, hit the like button and subscribe for more ways to take control of your money. Thanks for watching, and I'll see you in the next one.